Welcome everybody. I Prakash Ranjan Sinha welcome you back to the third chapter on this financial literacy. And first two chapters which I talked about was on managing income and expenditure and then saving. Now the purpose of the whole thing was to save some money, but to use that money, whatever you have saved, for some meaningful purpose. Not keep it idle at home, but to invest. Why? Because investment means some purpose. So we are going to talk about investment in this session. So what will be covering? Let's look at it. We'll be talking about what is risk, fundamental of investment options, understanding return, factors which are affecting returns, and the investment strategies. Now, let me tell you one thing. Warren Buffett, which is a well-known value investors, which is one of the most admired and respected investors across the globe, said one thing. Wherever you are investing, you should know why and for what you are investing. In case you don't know, then better not invest. Now, if somebody is reading that statement of Warren Buffett, he's not saying don't invest. He's saying know why and for what you are so the key word here is why and for what. Now, whenever we are investing anywhere, in any product, there has to be some reason why. For what? Now, these two things are very, very important. Why am I investing? There must be some purpose. Because whenever I'm investing in any product, I'm looking at some favorable outcome. And the favorable outcome is maybe regular income, maybe growth of money, maybe preservation of capital. It could be anything. So I'm looking at all those things. Now, but one thing which is very, very important in the whole course is, which can impact these two things, is the risk. That's why he had said this sentence. You should know why and for what you are investing. Because if I don't know what will be the end outcome, what will be the end result, then it's not going to serve my purpose. So that's the first thing. Now, there's another thing which I'm going to tell you about risk. Now, when we talk about risk, it can have different meaning, different perception for everybody. But one way of countering risk is the more you get financially educated, financially literate, you are managing the risk. The lesser you know, the risk is more. Now, each one of us want the best. But as we have seen in our earlier session, nothing comes free. There is time, there is effort, there is a disciplined approach. So many things are there. And if you look at it, yes, everything comes with this type of risk also. For example, time itself is the biggest risk. Things do not happen overnight. Discipline or indiscipline. If I'm indisciplined in any of my activities, forget about investment. That's a risk. And we have seen how people make their life very miserable by having a very indisciplined way of living. So if you look at it, effort, same way. So these are all things. Now, when we are talking about risk in investment, and definitely what we mean about that I should not be making any loss. I should be getting a good return. I should be getting a regular income. All these things are there. So that's why if I want to know the answer of these two for why and what, I need to have a financial education. So we are going to talk in detail about that. And risk reduces as your financial education increases. So let's go ahead and try to understand the risk in detail. What is risk? Now, for different people, risk can mean different things. Maybe for some, it is uncertainty. When I'm saying uncertainty, I don't know what's going to happen. For example, let's say if I say something, what will be the weather, let's say 1 month from now? Nobody knows whether it will be raining or not raining. So uncertainty is something. Now, whenever we do something, we don't want uncertainty. That's for sure. We always want something which is certain. But of course, things are not in my control. There are so many things which is beyond my control. Even if I want something to happen like this, maybe exactly it will not happen. Today, when we are talking of an investment, ultimately I'm investing in some assets, some investment product. And those assets, those investment products, do get impacted by so many external factors. So there is an element of uncertainty. The second is, which is a very, very common way of looking at risk, is loss of money for most of the people. I've invested 1 lakh of rupee. I don't want 99,999, not a single paise. But again, loss of money is something also should never be looked from the notional perspective, but it should be looked from the real perspective. And as we have seen in our earlier session, it's the real rate of return or real growth of money that should matter, not the notional. So loss of money, it should not be taken more from the nominal point of view or notional point of view, but it should be taken in a real sense. That means net of inflation. I should not be losing any money. Third could be getting less than expected. Now here there are two things which are very important, less and expected. Now, one way of looking at it is whether my expectation is correct, realistic, or incorrect, unrealistic. So this itself has got a lot of meaning. For example, if I'm expecting something which is not realistic, and if I don't get that, if I get less, then definitely I feel a risk. But maybe that's not a correct way of looking at it. So whenever you are expecting, it should be realistic and correct. And if you are getting less than that, then of course that could be. So here the expectation itself has got a very, very big meaning, what I'm expecting. Having unrealistic expectation. Now, let's say for example, so many people invest in stock market. And we have seen last 1 month, 3 months, 6 months, the return has been phenomenal. Now, one should not form an opinion that if last 3 month return has been, let's say 50%, going forward, if I am going to also invest and I will also get a 50% return, then that is a wrong expectation. You cannot have that type of thing. Because as we have again sort of, there are a lot of factors which are impacting. So when we talk of risk, there are so many different ways of looking at risk. But I would always say the biggest risk is not understanding the risk. Now, let me give you one situation. The life which we are leading, is it risk-free? It is not risk-free. I'll give you a very simple example. For any person to survive on this earth, There are three basic things which is must, which is air, water, and food. And today, when we look at it, the air, what we are breathing in, all of us know the pollution level, all other things, that is also not pure. The air quality level is deteriorating like anything. So, are we breathing good quality air? No, all of us know it. Now, let's talk of water. Now, water is something all of us know which has been created by nature. But when we again look at the water which we are drinking, is it pure? How many of us just go and take a tap water? No. Again, we are having aqua god or something like that, which is purifying the water. So even the water which is being supplied to us is not pure. Maybe there are a lot of mineral waste which are there. Maybe there are so many things which is not good for our health. So that is also not pure. The third thing, let's talk about food. Now we are eating so many things. But if you really look at the whether even those products which are natural, food grains, vegetables, fruits, even they are also being, the farming is being done using lot of, maybe I would say, chemicals and certain other things, which maybe in long run is not good for our health. Now, when we are talking about these three basic things, which is must for us, each one of us, even to survive on this earth, air, water, and food, if they are not risk-free, it means simply life is not without risk. So, when we talk about risk, the first thing I should know about this thing, life is not so. If that is the situation, what we can do? Can we run away and go somewhere else? No, sorry. I'll give you a very extreme example, maybe on a lighter side. Many people say, go to Himalaya and do some tapasya there. But today we know even the glaciers at Himalayas are also melting because of global warming. Antarctica is melting. So today, if you look at it, we are living with risk. Our life is full of risk. So the first thing is, of course, understanding the risk. And life is not without risk. Now, if life is not without risk, then what we should be doing it? We need to so the best course of action what we can do is understand the risk, what is there, which can have an I need to face its impact, and the last is how to manage the risk. We cannot run away from the risk. Anybody who thinks by running away from the risk he has managed his life and investment, then sorry, you cannot do it. I cannot control the rain, but I can save myself from becoming wet by carrying umbrella. So I should know how to manage the risk. When I am going out, the sun is very hot, but I can save my eyes by wearing a sunglass. So I should know the risk its impact, and how to manage the risk. So that's the real thing when we talk about risk and its management. Now, let me extend the risk thing further. We have been talking about certainty and uncertainty. So there are certain things which are, there is certain and uncertain. There are certain things which are controllable and certain things non controllable. There are certain things which can say permanent or maybe temporary. Now let's look at the three things from a very, very different perspective. Now we are living in a world where there is a lot of uncertainties, but again, there is some certainty also. For example, let's say, what will happen to the stock market? I don't know. What will happen to my investment? I don't know. What will be the political scenario? I don't know. What will be the global scenario? I don't know. What will be the level of inflation? I don't know. So, lot of things which I can say is uncertain. But when I look from the certainty point of view, then one thing is certain: everybody wants a good life. Everybody wants money to grow. Everybody wants the assets and investment product to do well. So again, it's both the things. Within uncertainty also, there are certain aspects which is leading things to happen. Now let's talk of controllable and non-controllable. Now there are certain things which are not in our control. For example, inflation is not our control. What will be RBI's decision is not in our control. What will be government policies is not in our control. What will be the budget which will be coming is not in our control. What will be the crude prices? This is not in my control. So there are so many things which are not in my control. But again, since I'm taking decision, looking at my benefit, for example, how much safety I want, or safe return I want, regular income I want, or I want growth of my money. Now this is control. So again, there are external factors which is not beyond my control. It's non-controllable. But again, there are some internal factors which is linked to me, is controllable. So the objective is always should be focus on controllable and try to manage the non-controllable. Now let's look at the permanent and temporary. Now nothing is permanent in this world. Let's be very clear. Only those things are permanent which has been created by God. For example, sun, earth, moon, all of us know it. That is permanent. Whatever has been made by human being is not permanent. Industries keeps on changing their shapes. Companies come and die. Investment products come and again replaced by some other investment products. People, attitude, behavior, everything changes. So again, when we are looking at all these things do impact the risk. And as I told you, the biggest risk is not understanding the risk. Once I know all these things and its impact and how to manage it, then I can manage the risk. Now, as we were talking about investment, and it's very clear why we are doing an investment. Ultimately, investment is nothing but a money management. And why it is investment, the other form of saying investment is it's a deferred consumption. So we need to understand ultimately what is the important thing is here, the money. And that has to be managed. Now, I can look investment from two perspectives, either in terms of money. For example, let's say I have invested 1 lakh rupees, it has grown to 5 lakh rupees. So it's very clear, I have got 4 lakh more. Or I can look at more from the return perspective. Same way. So return is a calculation. Ultimately, what involves is the money. That's very important. Now, ultimately, what I'm looking at, Money should be safe. It should grow. I should get regular some money. So it could be anything. It could be protection of capital. It could be anything. Objective could be anything. But if you look at it, everything is linked to money only. Now, when I'm looking at everything at money, so ultimately all these things gets impacted by something called risk. Now, there's a very, very important thing. Risk and return. Let's be very clear. Risk and return. Risk and return are the two sides of the same coin. We should remember. If there is no risk, there will be no return. Higher the risk, higher the return. We must have heard all these things. So we need to understand risk and return are the two sides of the same coin. But there is a difference. Whenever you invest, wherever you invest, in whichever assets, whichever investment product you invest, it is subject to risk. There's nothing risk-free, which I told you. But what is important here, when I look at the risk and return independently, and if I want to draw a relationship between the two, and each one of us, whenever we are investing for return only, which I have already explained to you. But important thing to note here is risk is not dependent on return. Risk is not dependent on return. But return is dependent on risk. Now, it's a very, very important thing for us to understand. Risk is something coming from so many external factors, and return is something what I'm getting it. Now, when I again look at it, risk, because if I'm looking at a good return, safe return, high return, whatever word I can use it, ultimately I have to look at the risk also. Nothing comes free. That's why it is told, higher the risk, higher the return. No risk, no return. We always hear this word also, no pain, no gain. That means there has to be some element of sacrifice. There has to be some element of risk, taking ability. All these things are there. Now let's look at the risk itself. There also, there is something called notional, and there is something called real. Real risk and notional risk. Let's use the word. Now, I'll give you an example. Let's say somebody has invested today in XYZ stock, and he has invested, let's say, 1 lakh rupee. Let's say after 5 days, based on the market value, this 1 lakh becomes 85,000. Now, there is clear loss of 15,000. But it is only on paper. That is called notional risk. Let's say after some days, this 85,000 again grows and it becomes 1,25,000. Now that person had invested 1 lakh, now which has become 1,25,000. Now it has grown by 25,000. That is also a notional risk. When I'm saying notional risk, it is only on paper. It will become a real risk when you take some action. But let's say if somebody sold it at 85,000, then actually he had made a loss of 15,000. Now that becomes a real risk. So we need to understand between notional risk and real risk. Notional risk is still, it is there, you have not acted upon. But real risk is when you act upon. Now, of course, risk is there, but we should get affected only by real risk, not notional risk. But if we take a wrong action, out of panic, out of fear, out of maybe somebody's wrong guidance, then it will become a real risk. Now, when I'm talking about the risk, Just like what we talk about notional return and real return, risk also has to be looked in the same way. And as I told you, risk is not dependent on return, but return is dependent on risk. So where I have to protect myself when I'm making an investment, it is the real risk. That's the way I have to protect myself. So real risk can happen from any of the behavioral aspects, anything wrong which has been done. It is only on the paper. So when you realize a return, this is what gets affected. Now just look at this. There can be different way of looking at it. There is a glass where there's half full by water and half is empty. Now, somebody can think maybe there is an opportunity of more water to be poured. So this is an optimist. Maybe somebody is thinking or concentrating more on what has been filled and is even not looking at what is the opportunity. For example, somebody is quite contented, whatever is happening. Maybe somebody is looking at no, there's enough scope for filling it up. So there are different ways of looking at risk. Some people will think, why I should be taking a risk? My life is good, boss, everything is going good. I'm earning good salary. I'm meeting all my family expenses. So I didn't need to invest. Or even if he's investing also, maybe he's looking at the safer product. Maybe something, let's say, every type of thing. But as we have seen, inflation is the biggest enemy of the money. And long term, inflation erodes the purchasing power of money very drastically. If somebody thinks, boss, I don't need to invest, let me put my money in my home. But all of us know, even if he has kept, let's say, 1 lakh rupee at his home, after 10 years, if he is taking out, though the notional value will remain the same, but the real value is going to get reduced. The purchasing power of that 1 lakh has got reduced. So by not taking any risk, you have not gained, but you will always lose. Let me tell you, whatever situation somebody can think of, by not investing, by not taking any risk in investment, you are never going to gain. You will always lose. So the best way to manage risk is look at the opportunities, look at the scope, and take advantage of it. So the biggest risk is not taking any risk. So as I told you, real risk is what should matter to me and not notional risk. But very important thing here is to understand is notional risk just plays in our mind, our psychology. And real risk is something which actually happens. So what is important? We need to protect ourselves from real risk. But notional risk, as I told you, it does play on our mind. Now, before we go ahead, we need to understand whenever we are making any investment in any asset, any product, nothing is risk-free in this world. That's for sure. I mean, I told you example when we had our earlier session. So whatever, wherever you invest, even the safest of asset, let's say government securities, GSEC, that is also subject to interest rate risk. So whenever I'm investing, I want a good return, safe return, regular income, all these things I know it. But different risks do impact it. So what is important for me to understand the risk first? Now, when I'm looking at the risk, I'll divide it into 3 parts. Understand the risk. The second is impact of it. So impact of that risk. And finally, nobody can remove many of the risk, but yes, how you counter the risk. If I know all these 3 things, believe me, no risk can harm you. I mean, let's look at an example in our day-to-day life. If I know what's going to happen, what will be the problem? Let's say there is a pitfall on the road. Waters are there logging in. So once I know all these things, and if I know how to counter it, how to save myself, then of course I'm not going to get any harm. So these three things are very, very important. Now, there are n numbers of risk which impacts your investment or your investment products, all assets, all these things. Now I need to understand these things. I'm going to explain you in these three. The first one is inflation risk, and we have already talked about it in detail. Inflation is nothing but erosion of purchasing power of money. Now it's all about money only. I require more money. So now what inflation is going to do? It's going to impact the final money which I'm going to get it. I'm going to get lesser money in my hand because of inflation. So I got this. What is the risk? What is the impact? Now, how I'm going to counter it? Because ultimately, what matters to me is the real rate of return or real return. So every product is giving me some or the other return. So two things which you have seen it. One, inflation impact will be on all assets, all products. But there are some product where the return, notional return is more. And there are also some product which in long term gives you a higher return comparatively to other assets. There are some assets where the impact of inflation is more in long term. And we have seen that inflation impact is more in long term. So what I'll be doing it, if I want to counter that risk, then I'm not going to expose myself to those assets where the impact of inflation is more. I'll be going in those assets where the impact of inflation is less. For example, let me tell you, we have got two choices: investment in debt or investment in equity. Now, debt is the best asset to invest in short term because of the safety characteristic, because risk is maximum in short term. So I don't want to take risk on the equity side. But when I look at the equity in long term, then all of us know equity is a growth asset. And this growth is coming from the consumerism. So now, as our consumerism is increasing, we want better life, better lifestyle. So equity, in all probabilities, will give you the best return because of growing consumerism, because of growing economy, and all these things. Whereas debt, though it will continue to give you a notional return, but the real rate of return is going to get impacted. So I know what is good for me in short term and what is good for me in long term. So I can counter it. Now let's look at the other thing, which is liquidity risk. Liquidity means very simple. Whenever I want my money, I can sell it and I get back into cash. So again, how to look at it? So impact is there. Now let's say if I want to sell it and I want to convert it into cash, can I do it easily? I'll give you one example. In our country, everybody has got a very, very strong obsession for property, real estate, flat, house. Most of the money, savers' money, is in that side, if you look at the RBI data. But can I sell my flat immediately and can I get into cash? No. All of us know it. It's not so easy. You have to find a buyer, then there will be negotiation. So many things will happen. So I cannot sell it today and I can get into cash immediately. So when I'm looking at the liquidity risk, I should know what are the, again, asset securities where the impact is more. And as I give you the example, real estate is not liquid. But there are some assets, some securities which are liquid, which I can sell it easily and can convert into cash. So I need to expose my money if I really want money anytime, not to get into those assets where there is a liquidity risk. Even if, let's say, there are some investment product where I can sell it as and when I want, but again, there might be certain penalties clause if I want get it before that. For example, let's say tell you, if you want to go for a bank FD, now you have given 5 years bank FD, but let's say you want to sell it after 1 year, some penalty will be there. So you need to understand the penalty charges, exit load, if any, and then you have to choose the right product. So you can counter that risk. Now let's talk of the credit risk. Now, what is credit risk? Credit risk means simply that if somebody is giving money to somebody, that person has taken a risk. Now, this credit risk is in debt, because in a debt, we loan money to somebody, we give money to somebody. Now, the risk, let's say if I have given money to somebody, for me, the risk is, will I get my money back or not? So whenever I'm giving money to somebody, or whenever I'm taking money from, let's say, bank or anywhere, all of us know it, there are certain features which are fixed. For example, the interest rate, the coupon rate is fixed, frequency of coupon rate is fixed, it has got a predefined maturity, and also when the principal, the capital will be paid back. That means there is a cash flow pattern which is fixed. Now, if there is any deterioration or deviation from that cash flow pattern commitment, then that's a risk. Now, as per regulator guidelines, private sector companies, if they are raising money, they have to be mandatorily credit rated. So we have seen AAA, AA, all these ratings. So rating, in fact, gives us an idea about the credit worthiness of that thing. So this is one thing. Now, what risk it can happen? Now, let's say if you have invested in a AAA rated paper, for example, let's say, and rating is reviewed regularly by the rating companies. AAA becomes AA. What happens? That means the risk has increased. So let's say if the AAA becomes AA, it simply means risk has increased. So these ratings are done looking at the financials of the company, and now the moment risk is increased, what happens? It impacts the liquidity of that security which is being bought and sold in the market. That's one thing. Now, the moment the risk is increased, what will happen? Buyers' interest will decrease because nobody will like to more risky things. That's why generally you will see the lower rated paper offer a higher rate of return. But again, when I'm looking at the credit risk, we need to understand within our debt market, there are investment grade securities, there are speculative grade securities, there are default. So definitely default and speculative grade security is not to be considered. It has to be within investment grade only. And within investment grade also, the higher rated paper is good to invest. So I have to look at the credit rating. Even if, let's say, you are investing in some other, let's say, bank and other places also, you need to look at the credit worthiness of the bank. For example, let's say if somebody is investing in a PSU bank like SBI, PNB, Canara Bank, vis-a-vis something like on a Grameen Bank or something, then of course the risk is increased. So I look from that perspective. Now, default risk is a sub part of credit risk. So it has been already committed, when to pay the interest rate, what will be the frequency of interest rate, when the principal will be paid, all things are well defined. Now, anybody who has invested in any of the debt instrument, he knows it, what will be the cash flow pattern, how much is expected to get. Now, what's going to happen? In case there is deviation from what has been committed, for example, the commitment was to pay 8% per annum, 8% per annum, but paid, let's say, monthly, for example. Now, if it is not paid on the due date, then that's a risk. Or let's say if lesser amount is paid, then that's a risk. So ultimately, it is, as I told you, it's an extension of credit risk. But what happens if nothing is paid, which is an extreme form of a credit risk? That means you have lost your money. Now, again, when you look at it, I need to look at the rating because that gives me an idea. That's one thing. Not only that, there should be cushion also whenever you are investing. Don't get into a lower rated paper. Even within its investment grade paper, have some cushion there. So definitely default risk is losing all your money. So which is the biggest risk? So how you can counter the risk? That's one thing. Now let's look at the interest rate risk. Now this is a very, very important aspect. Now we are living in an economy where two things are very important for a country as a whole. One is the economic growth, which is measured by GDP, and the other one is inflation. Now this economic growth and inflation, to a large extent, they are correlated also. For example, let's say there is more consumption, more cars are purchased, more houses are purchased, people are spending more money. Now it's going to help on the economic development. But what happens with the more consumption? In fact, inflation also goes up. So again, economic growth can lead to inflation, rise in inflation at some stage of time. In our economic system, banks and lending institutions, they are offering or they are getting money at some interest rate. Now, what will happen? That interest rate, assuming that, let's say, if the inflation is 6%, let's say, for example, and the interest rate is 7% at that point of time. Now, what will happen? If the interest rate is less than the inflation, then we are in a negative interest rate situation. So at any point of time, the interest rate has to be on the positive side. That means more than the inflation level. Now, inflation, as I told you, it's not anybody's control. Though RBI, government, they try their best to control it, but again, it's coming from the billions of people consumption. So we have seen inflation sometimes going up, sometimes going down. That's why interest rate is revised on a regular basis. So we have got certain policy decisions which are taken by government, and also based on that, banks also based on, or lending institution based also on their own outlook about the credit offtake in the market, or maybe growth requirement, or consumption level, or inflation level, they take a call, and then interest rate keeps on changing. Now, whenever the interest rate changes, what can happen? Now, I'm looking at the interest rate from two perspectives. One from long term, and the other one from short term. Now, it's very, very important. Long term, if you look at the trend of interest rate in our economy, we can see it is declining. But if you look trend of interest rate in short term, maybe sometimes going up, sometimes going down. It's like this. Long term, why it is declining? Because in long term, the government and everybody wants growth. Now, interest rate is a cost. For example, let's say if you are paying 8% for any borrowing or any loan, tomorrow if you have to pay 9%, that means it has increased. So the cost is definitely is a drag on the net saving or net profitability. So since the economy wants to grow, corporates wants to take money for their expansion plan. We as a consumer want to take for our consumer activities. Government also takes money for infrastructure development, road, transport, all those things. So long-term objectives is growth. For growth, you need to have a lower cost. That's why the trend in long-term for an evolving or a growing economy like India is interest rate has gone down. And you can look at it. What was the interest rate in 80s, in 90s, in 2000, and now? You will see there is a declining trend. But as I told you, in short term, you have to also look at the inflation. So there has to be a fine balance between the two. So that's why in short term, interest rate can go up, whereas in long term, it's down. Now, this is a very, very important thing. Once I know these things, that means in short term, it will go, but it doesn't go beyond our level, because inflation also does not rise very suddenly. And also RBI takes some corrective actions, or they wait for some time before they take that decision. But what is important here is a long term. Now, if the long term interest rate is declining, and I can tell you, if you look at the PPF rates, NSC rate, bank FD rate, you will find it is not the same what it used to be some 10 years, 20 years. So if long term rate, if interest is declining, and if I'm investing for long term, then of course my return is not going to be very high. It is going to be less. So again, how I'm going to counter that risk? Now, reinvestment risk, again, it's a extension of interest rate risk. For example, let's say till 3 months back, the interest rate for any rated paper or any debt paper of a particular risk profile was, let's say, 8%. Now, when it reduced to 7%, that means any investment which is done at 7% will be at a lower interest rate. So that means money is getting reinvested at a lower risk. It can go up also. So again, reinvestment risk, ultimately I am going to get a lower amount. Now let's look at the market risk and the price risk. When we talk about market risk, we need to understand few things. Basically now I'll be focusing more on the equity. In a market, there are every type of people who are operating, let me tell you. We have got speculators, we have got day traders, we have got arbitragers. So you've got every type of people who are operating. Somebody wants quick profit. Somebody have got patience. They can wait for some long time. So people have got different expectation, and based on their different expectations or how they look to maximize their profit, their behavior can change. The other way to look at market risk is also when we are living in an economy and our economy is integrated with world. So within our country or even integrated with the world, or there can be good news, there can be bad news. Now, bad news can have a negative impact on the market. Good news can have a positive impact. Same way, industry-wise also, there can be good news, bad news, company-wise. So all these things will be there. So what happens when I'm talking about the market is it's all to do with the how I perceive and how I take the action, whether I'm a net buyer or I'm a net seller. Now, when these things happen, of course, there will be a price risk. For example, the price of a equity which was 150 yesterday might become 170 because of maybe some positive news, might become 200. The other way around, it could be also maybe from 150 it can become 100. So these things will happen, and this is what is called volatility. Volatility is nothing but a movement of price. Now again, when I know, yes, volatility will be there, so I know which is the asset which is less impacted by the news and views. Now, since in a debt, the cash flow pattern is mostly known, I can lose money only if there is a default, or maybe if there is a change in interest rate, and if I've invested in a marketable debt securities, then it can have some impact. So volatility is much, much lesser in debt and much higher in equity. That's the difference, because in equity, everything is linked with the fortune of the company or the business where you have invested, as well as the economic and market factors, so many things. So once I know this thing, volatility does impact. Now, the second thing is when I look at the performance of the asset or the company where I've invested, in long term, the return is linked with the fortune of the business, performance of the company. Whereas in short term, it's the sentiment which impacts the price. So sentiment is something very hard to judge. What was good today may be totally different tomorrow. So if I know this thing is going to happen, let me not expose my money, which is more volatile in short term. So in short term, definitely it has to be safer asset, which is debt, not equity. Now let's look at the political risk, which has to do most with the government policies, taxation, priorities of government. All these things are there. Political stability. So you will always find a country where there is a political stability, where government is able to take some good, bold decisions, then that evokes a confidence in the investors who are investing from abroad. Because in our economy, it's not the domestic money which is getting invested. We are getting a lot of money from foreign monies also, maybe in FDI, FPIs, or foreign portfolio investment. So these monies also do have an impact. Now, if they view a positive scenario from the political front, then of course more inflow will be there. If they view negative, then of course there will be outflow. And that can again impact the price and add to the volatility. Economic risk. Now, economy moves in cycle. And now all of us know there can be sometimes positive things happening, which you call it expansion. There might be sometimes slowdown. There might be sometimes recession. So these things are there. Now, a very, very important thing for each one of us to understand. No economy moves in a linear form. There will be always ups and downs. Let's be very clear. So it will be, movement will be like this. It will be there. It will be there. So those risks are there. We need to understand. Now the question is, when I'm investing, what is the situation and what is expected to follow? That's very, very important. For example, let's say if somebody has invested when the economy is very good and expected to do better, then of course you will gain to gain. But there also in which asset, win product, because again, the growth asset, or maybe somebody who has invested in, let's say, real estate, they are going to gain. Now, let's say the other way around is also there. Let's say if economy is expected to fall, recession, slowdown, then of course the price or the value of the equity or real estate will go down. So again, you have to look for the safety. Industry risk, it has to do more with the life cycle stage of the industry, sorry. Because every industry gets a birth. Like just like we people, like individual, we were young, child, teenager, adult. So like this, we have also a life cycle. Industry also have what has a life cycle. Now, industry, what life cycle that industry is. For example, let's say if I go back 20, 25 years back, then IT was something which is a very, very evolving industry. Today, I can say, yes, IT is a much grown or matured industry. So new industries will come. So those things are there. Now, if you are investing in a growing industry, then of course there is a good upside. But if you are investing in a decaying industry, then of course your risk has increased. Now let's look at the company risk. Maybe you have invested in Infosys or maybe Wipro or Hindustan Lever or anywhere. Now company risk is something to do with the company specific things. How good the management is. What are the fundamental factors of the company? Balance sheet, profit and loss account, cash flow movement, utilization of the debt. All these things are there, which are measured through different metrics, different ratios. So again, when you're investing in a good company, which has got all the things good, of course, you are going to get a good return. Good. But if you are investing in a bad company, which is expected, which is not doing well or expected to do bad, then of course you're going to lose the money. So, as I told you, these are the risks which will be there, which none of us can avoid because all these things are external. Please look at it. All these things are external. But what is important, a bad thing or a bad impact can harm me only if I don't know how to counter the risk. So that's the very, very important aspect whenever we are making any investment decision. Now, let's look at the investment fundamentals. We have already talked about saving and investment. Are they same? Maybe some people I've seen, they are investing in some traditional investment product and they will say it's an investment. Now, we need to understand. When I use the word saving, if you remember, I said there is an element of safety. So let's say I have saved 10,000 rupees. I have saved. That means I have not consumed all my money. I was earning 50,000. I spent 40,000. I have saved 10,000. So when I say saving, my focus is more on the capital. I should not be losing the capital. I'm looking at the protection of the capital. Saving is something to do more from the safety. Now, when I'm looking at the investment, I'm looking at the opportunities. Now, that's very, very important. When I'm looking at the investment, it is to do something with my goals, my requirements. For example, let's say I want the best of education for my child 15 years from now. So it's but obvious that the cost of education is going to go up. Can I put my money in something like saving and expect the money to go to that? No, it will not be there. I have to invest in some right assets. So saving and investment is not the same. Saving is a process, habit, where investment is an action. So it is a habit. Saving will always precede before investment. Please, saving is also very important. If I'm not able to save, then from where I'm going to invest? So I need to understand both the things. So objective of investment is to earn profit. When I'm saying profit, it means gain. It is gain. Because we are not investing for loss, let me tell you. Anybody who is investing for gain. But when I'm looking at the gain, I have to look at it from very real terms. So if you look at it, if I club both the things, both. So here, let's say I'm saying it is safety. When I'm looking at investment, it is growth. Now, ultimately, what is I require? I will club both the word together. and I will say let me explain you. For me, the risk means wherever I've invested, in whatever product I have invested, whenever I require money for the purpose for which I have invested, I should bet getting the desired quantity of money. Please remember, desired quantity of money. And as I showed you in earlier slide, in short term, there are so many factors which can lessen your money. So safe growth, again, I have to protect from that. But in long term, also we have seen inflation can impact, as well as there are some growth assets which can give you a higher return. So ultimately, it's not only about safety or growth, it's about safe growth. Means whenever I require the desired quantity of money, I should get it. That's very simple. But high return comes from high risk. Now, when I'm saying high risk, what do I mean? I don't mean that you should be taking a loss. It means I should be tolerant enough to face the volatility. For example, let's say I have invested in a good quality equity. For sure, I know that this company, for example, let's say Infosys or Maruti, I'll give you an example of Maruti. Now, for sure, I know people want car. And Maruti is the most dominant player in the car market, car segment. And since people want car, and Maruti is the most dominant segment player in the car market, of course, if I invest in shares of Maruti, in long term, it is going to go up. Maybe in short term, yes, because of market factors, volatility, all those sentimental reasons, prices can go up and down. But in long term, definitely I'm going to get it. So when I'm saying safe growth, it means that means I'm tolerant towards the volatility in short term, high risk. This is what I means. And as I showed you in my earlier slide, once I know the risk, its impact, and how to counter it, then of course there is nothing like it. Taking risk does not guarantee a return, and it is said, market gives you the best of opportunity. Please remember, economy gives you the best of opportunity. But the question is, has everybody gained out of it? If you really look at it, today when I look at how many people have invested in equity, it is far, far less than people who have invested in PPF or NSE or any other debt product, traditional debt product. I'm not saying these products are bad, please remember. But what I'm trying to say, even if I look at from the historical return perspective, equity has given the best return. Let's say, for example, let's look at the Sensex. Sensex sum was 100 in 1980s, 81. And today Sensex is 72,000. And we are in 2023. So if I calculate number of years, only 43 years. But 100 has become 72,000 in 42 years, 43 years. Now, similarly, if I look a lot of, return from good equities or good mutual fund in long term, I have seen it has given a very good return. But the issue is how many people have invested? For the very simple reason, maybe they were not tolerant to this. That's one part. Or, as I told you earlier, they did not understood the risk correctly. So, taking risk itself does not mean guaranteed return. Taking risk is how behave. That's the key word is this. Behave. If out of panic, if out of fear, out of greed, if you take a wrong decision without understanding the three factors which I told you, the risk, impact, and counter, then of course you can. So right decision is a very, very key thing. So once what risk to take, what risk not to take, I should be knowing it. There are only three requirements, as I told you: liquidity, safety, and growth. So for any person, whenever he's investing, there are only three considerations. I can convert into cash as and when I require it, because I have invested for some purpose. It's a deferred consumption. It should be safe, and there should be growth. So when I club it all three, it is a safe. So when we are talking about investment, of course, you are going to invest in some assets, some investment products. So there are a lot of investment options. Now, no asset or no investment product I can say is bad. But yes, the other thing is also no asset or no investment product can be good at all point of time or to everybody or is suitable for everybody. That's the key here. So options, yes, a number of options are there. But if you look at it, there are some products like option futures, collectibles, which are high risk. Then you have got middle real estate, equity mutual funds, high income bonds with mid risk, and of course the base, which is. So if when you look at it, you will find one thing. When we talk about the base, it is all debt. When we talk about this middle base, it is equity plus high income bond, and of course above it. There is two words here: high risk and low risk. What do we mean by this? Let's talk of the highest risk first of all. Now, many of you might have heard or read somewhere that person had made a huge profit by trading in derivatives. Option futures, these are all derivative products. He has made a huge profit. Now, again, we need to understand this thing. If making profit or magnifying your money was so easy for everybody, then everybody would have made it. Please make it very simple. It's not so easy. Somebody who has made it, of course, they have deployed some strategy style. That's very, very important. So, derivative products, again, is whatever you get it. It's a function of the strategy which you put it. But here the question is, if your strategy goes wrong, then what can happen? That's the key here. Then, of course, you are going to make huge loss also. So when I talk about high risk, it also, as we're talking about, high risk come with high return. That means if you're ready to take high risk. Now, the question is, I know my capability. I know my skill set. I know my knowledge. I know how much risk, which I'm talking about notional risk, I can tolerate. What will be the impact on my psychology, my behavior, my mindset, my health? All these things I know it. So if I'm not confident, why should I be going for it? But if yes, if I can tolerate it, if I'm ready for that, I can go for it. So as I told you, this is not bad or something like that. It's a question is the impact and whether you are suitable for that. Now let's look at the middle. Same thing. It's equity. It's all market related. What is going to give real estate? Again, function of economic situation, infrastructure development, all these things are there. But when you look at the low risk, it's all debt. Why debt is considered to be low risk? Because in a debt, as I told you, the cash flow pattern is well known. The coupon rate is fixed. Frequency of coupon is fixed. Maturity is fixed. When I will get my principal back is fixed. So that's why it is. So what I'm saying when I say high risk and low risk, there is something called expectation of return. And there is something called realization of return. Of return. And risk is simply difference between expectation and realization. Is it clear? So that's very clear. Now I'll give you an example. Let's say if I invest in a bank FD. The bank managers told me, sir, you are going to get 7% return. So my expectation is very clear, 7%, and my realization is also 7%. So I would say it has got a risk, low risk, because the deviation between expectation and realization is less. And even if you consider some of the money market instrument, or let's say those instrument bond, which is tradable in the market, but there also comparing with equity, the deviation between the expectation and realization is less. That's why they are falling under low risk. Whereas, as I told you, here you don't know what to expect and what you're going to get it. That's why we need to understand high risk and high return. It's all about expectation and realization. Now, a very key important word here is expectation is something what you need. That's very, very important because I have invested for my need, for my goal. So expectation has to be in line with the need. Whereas realization is again a function of so many external factors. So many external factors. I can tell you, so many external factors are there. It's not one, two, which we already talked about this thing. Which factor can have an impact? I don't know. That's why whenever we are talking about risk and return, we need to understand that my investment has to be in a product where there can be. Now, somebody can say, boss, equity is a risk. But you are saying equity is best for long term. Why? Because the reason is very simple. How much I will get it, I don't know. Only God knows, let me tell you very frankly. But for sure, one thing I know, everybody on this earth wants a better life, better lifestyle. Now, let's talk of India. We are a 140, 145 crore population. And when I look at the lifestyle of an average man, or even the poorest, I see there is a drastic change. The same level of poorest, maybe some 20 years back, was not thinking of all those things. But today they are thinking. So what I can easily judge, today everybody wants a good life, good lifestyle, which they are going to get some of the product or services. And this some of the product or services are provided by some of the other companies. And these companies have got their shares in the market. So if I invest in a good, profitable company share, whose product is in demand by the consumers, then of course I'm going to get it. So when I'm looking at even expectation, there should be a complete clarity on that. And that's once I know it, then I have to take a decision. And as I told you, everything is good. Please, nothing is bad. But it has to match with your need and also your ability, which is risk-taking ability. So what are the investment options and risk? All government guaranteed schemes, like let's say PPF, NSC, EPF, these are all government guaranteed schemes. Now, wherever there is a government guarantee, there will not be any default. Because once it is guaranteed by the government, somebody is going to get that money. So that's very clear. So as far as risk is concerned, no risk with respect to return. But when I'm saying no risk, it is to do more with the credit. Please remember. Why I'm telling you those things? Because, of course, today there is something called interest rate risk also, as far as debt products are concerned. So we see that today, all government guaranteed products also, the return is not guaranteed for throughout the period. The return also keeps on changing. For example, PPF rate, it keeps on changing. NSC keeps on changing. So this also keeps on changing. But again, the risk is less, I would say, compared to any other products. Then you have got bank deposit. Bank, again, is one of the safest product. But again, within bank also, you have got big bank, you have got small bank, all those things are there. So if somebody is investing in a smaller bank with a lesser credit worthiness, I would say, when I'm saying lesser credit worthiness, I mean to say where the interest of the depositor is not so big. For example, let's talk of a Grameen bank. You have got a Grameen bank also, cooperative bank also. But when you look at those banks, they are localized to a very few locations. And only maybe people or resident of those places are investing in those. But maybe if I take State Bank of India or Bank of Baroda or Axis Bank or ICICI Bank, then we see they have expanded to almost all the cities and towns of the country. So those things are there. Then you have got National Pension Scheme, NPS. Now today, all those who are working in Government of India organization or PSU, it's mandatory for them to have a account in NPS. But those who are not working in government or PSU, that means let's say private sector company, it's a voluntary option for them. So again, it depends upon whether you are going for it or not going for it. There also you have got a choice, which type of portfolio you want. So you've got different type of portfolio. Maybe something is having weightage of equity more. Maybe somewhere weightage of government securities there. Maybe somewhere weightage of corporate bonds are there. Or there is a mix of all those things. You have got life cycle stage funds. For a person who is of 30 years of age, 35 years of age, the proportion of equity is more. So as the age increases, the proportion of equity decreases from the total portfolio. So again, return, as I told you, is a function of where your money has got invested. Debt or equity or government securities. It will all depend upon that. Premature withdrawal, again, it's not possible. I mean, there are some preconditions there. PPF and EPF, premature withdrawal is not there. After some time, of course, you can take loan, maybe after 7 years. So there are certain restrictions. Interest normally is changed every year. So it's not that what I have invested today, let's say if I continue to be there for 15 years, I will continue to get the same interest rate. There is a very, very important thing for each one of us to understand. There are many people, if you ask them, they don't want to take risk. They will say, I don't want to take risk. When you ask them, sir, what do you mean by that? They will say, boss, I want something which is fixed, assured. That's our general mindset. As I told you, nothing is risk-free in this world. No investment option is risk-free. Even today, when I'm thinking PPF, EPF, NPS, bank deposit, which are primarily a debt investment, the safest, because things are assured, let me tell you, it's not assured. That's where we are going wrong. Because let's say you go to a bank today and you ask that, okay, I want to deposit for 3 years. Maybe bank manager will say 7% is the per annum interest is what I'm going to give you. You go after 6 months. Maybe the interest rate is higher than 7% or less than that. It can be same also. So even in bank FD also, the interest rate keeps on changing. All these products, interest rate keeps on changing. So this notion which we have got, I want to invest where everything is fixed, assured, that's not the situation. Maybe when I'm getting it there, I'm getting something fixed, but that is also fixed for some years. Let me tell you, for example, let's say if I do a bank FD today for 3 years and I'm getting, let's say, 7% per annum. After 3 years, when I again renew that investment, let's say for another 3 years, then I don't know what I'm going to get it. It can be 7%, it can be more than 7%, it can be less than 7%. So as we have seen, interest rate keeps on changing. So nothing is fixed. It is fixed only for the time period for which you have invested. And when we are talking about EPF, PPF, then it is the interest rate is changing every year. So please be very clear. As far as return is concerned, that is also the ultimate, how much money you are going to get. Again, it is subject to all these things with the change in interest rate. Now let's talk about stock, shares. Normally we use the word. Now you have invested in Infosys, Wipro, IndusInd Bank, any company which you have invested. Ultimately, the value fluctuates. Why? Because value fluctuation is on because of two reasons. One, sentiment in short term. And the other thing is in long term, it is linked with the fortune of the business. Fortune of the business means how good or how bad that company is doing, depending upon the financials. For example, whether the earning is growing or not, which we call it EPS, earning per share. Whether profitability, net profitability is growing or not. What is the level of cash flow? What is the level of debt? How correctly they are using their debt, whether they are paying their debt on time or not. There are so many factors which are impacting ultimately the profitability. So value of investment will keep on fluctuating. It is linked with the performance of the company. Since in short term, sentimental factor is more impacting than the actual company related factors, that's why volatility is there. That's why stock, if anybody is investing in stock, he should know again two, three things. Whether he understands all this risk. If not, then what he should be doing it. Then the other route is equity mutual fund. So why equity mutual fund? Because in equity mutual fund also, money is getting invested in different companies. But the advantage here is advantage of portfolio. Because money is not invested in a single company, single industry, single security, but multiple industries, multiple companies, multiple securities. That is concept of portfolio. Money is invested after doing a thorough research. So there is a research team which does the research very thoroughly. What is good, what is bad. And then only they take a decision. So they do fundamental analysis, technical analysis, and then they take a call. Where to invest, at what time to invest, at what price to invest, how much to invest, all these things are there. But this is also subject to price volatility. The reason is, again, because the underlying things are the stocks there. Now let's talk about debt mutual fund. Same thing. Here money is, there is a concept of portfolio. Money is invested in debt securities of varying maturity, varying coupon rate, varying credit rating. But there also, it is structured based on the macro's duration, which is again linked with the cash flow, which is going to come on a weighted average method in the fund. So there also, yes, risk is there, same. Credit, interest rate, all this risk will be there because that is a risk. Underlying is again the type of securities. But as I told you, again, there is a concept of portfolio. Everything is invested taking a proper risk management is there by doing thorough research, when to buy, what should be a part of the portfolio. If something is looking bad, the fund manager is going to sell it, will not keep it in the portfolio. So all these things are there because in a mutual fund, the biggest advantage is money is invested in tradable, marketable securities. Now, when you are investing in a liquid form of a market, tradable, marketable, where I can buy, I can sell anytime, that means knowing the risk, I can offload that security if I feel it's not good or it's not adding any value to the fund. If I feel something else is better available, I will buy that. So that's one advantage. The second advantage is in a mutual fund, on a daily basis, people are investing or redeeming. That means there is a constant inflow outflow which is happening. So maybe even if you have purchased something at a high price, you get an opportunity to again invest at a lower price. So what is happening? There is an averaging of the cost also. So there are so many benefits of a mutual fund, which I believe when you'll be talking about mutual fund chapter, all these details will be explained. Now let's talk of a return. Very simple. I've invested in bank FD. I'm getting 7% per annum. So my return is this simple return, which I can say it's interest return. The other way is compounded return. So we have already talked about compounding, which is nothing but interest on interest. So how you calculate it? This is the formula. How much you will be getting it? This is again dependent on how much you have invested. This is the key here. More the principal, more will be the amount which you are going to get it. More is the interest rate, more will be the amount. And also, if the frequency is more of compounding, more will be there. So the second one is compounded return. Now, nominal return and real return, we have already talked about it. Let's say, for example, nominal return is 7%, but if the inflation is 5%, it's not this is you are getting. You are not getting 2%. Even you are getting less than that. Because the formula for nominal return is, for the real rate of return is 1 plus nominal return minus So you are getting less than that. Now let's look at the tax adjusted return. Now we all know about real rate of return, but there is another thing also which is called tax adjusted return, or we can say net return. For example, let's say if somebody is getting 8% return, and if that person is under 30% tax bracket, then he's not getting 8% in hand. He is getting 1 minus 0.03. Maybe somewhere about it will be 5.6%. Now, many times when we look at it, we get confused because we are looking at the nominal return. But when we look at the real rate of return, so here the example in PPF is given 8%. So, but here I've taken 8%, not considering PPF, but maybe I've considered something. Let's say if I can change it to 8.5% also. So again, corporate FD is again it is taxable, where this is non-taxable. So what is important is not the gross return which you are getting it, the net return. Net return always has to be net of taxation. So even if the gross return, let's say for an example here, 8.5% looks better than a PP of 8%. But since it is taxable, your net return will be much lesser than this return. So one needs to look at the tax aspect also. Now again, here as I told you, the other way of looking at simple return is, let's say for example, somebody has invested 5,000 rupees and he got 6,000. So his gain is 1,000. So if I calculate the return, 1,000 divided by 5,000, the amount which I had invested, multiplied by 100, simple return, it comes as 20%. Now the question is, yes, it looks very good, 20%, but whether it has come in 3 months or 3 years. So when you look at these two things, let's say somebody has got 5,000 invested and got 6,000. So the gain is 1,000 and the return is 20%. But whether this return was in 3 months or 3 years, that's important. Now, when I look only at the 20%, it looks same. But when I am comparing the two funds or two products, the return are not the same. For example, here I need to analyze in both the cases. So how it is going to happen? For the 3 month, it will be, if I do the annualization, it will be divided by 3. Whereas in this case, it will be 20 multiplied by 1 divided by 3. 1 I have taken because whenever you are analyzing it, on the numerator side, either you put day or month or year. So maybe days if you are taking, then it will be 365, month 12, and year it is 1. And on the denominator side, you have to take the actual holding period. So since here you have taken it in month, so if you look at it, the return, annual return of this is much more compared to this. Now let's look at it. What are the factors that affect the return? And we have been talking about the risk. It's not the market which gives you the return. Let's be very clear. It's not the product which gives you the return. It's also how you have behaved, what risk you have taken, what risk you have avoided. That's also very, very important. The same thing, let me tell you, the same equity might have given a 60% return to somebody in a 1 year's time, but the same equity might have given minus 30% return to somebody in the same next 1 year time. So it's very, very important to understand the factors which affect the return. So what are the things? What risk to take, which to avoid? That's very, very important. And as I told you, there are only 3 considerations: liquidity, safety, and growth. I have to look at it. And which I will always say, safe growth. For example, let's say if I've invested for 2 days, then definitely I'm not going to take any risk on this. I'm not going to expose my money in something which is more volatile or where the sentiment factors plays well. Definitely I'll be going for the debt. And within debt also, since there is an interest rate risk, I know credit risk, default risk, I will go for the best quality of debt, safest. Maybe I will go for something which is not exposed to market risk, that is interest rate risk. I will go for something which is on a discounted side. So I have to select that product, which risk to take. Again, it has to be dependent upon my requirement. How much to allocate? Now, a very, very important thing is, as I told you, all assets are good, all products are good, nothing is bad. But ultimately, I'm investing for myself, for my requirement, what is suitable for me. So, what is important is how much I'm allocating. Because my life is not of one day, 1 month, or 1 or 2 years. It's for many years also. So, maybe something I require it in immediate term, short term, mid term, long term. So, according to that, I have to allocate in the product which is going to give me the best result. Investor behavior. Now, this is a very, very important factor which I told you. It's not the market, but your behavior in the market. It's not the asset, but how you have dealt with the risk of that asset. This is one important. Now, there are a lot of biases, greed, fear. For example, let me tell you, herd mentality. Everybody is buying this, let me also buy this. Everybody is investing, let me also invest it. Sorry. Let's say if somebody XYZ has invested, but maybe he's tolerant towards risk. Even if there is a notional loss, he's ready to bear it. But are you tolerant toward that risk? Are you ready to bear that notional loss happening because of market factors, economic factors, sentiment factors, volatility, all these things? If not, then why following blindly what others are doing? Because you know your risk yourself. So always go for that. So biases is very, very important thing. The other one is, let's say, familiarity bias. Let's say, for example, I have invested in some product and that has given me very good result. Now I start thinking that this is the best product. But maybe there are better products than that also. Have I researched it? So just because I had a good experience, that does not mean that's the best in the market. There could be other better also. So I need to understand that. So there is a familiarity bias. Then there is another thing which is called confirmation bias. So what I mean by confirmation, let's say, I have already taken a decision, some opinion, and I try to confirm it with somebody. Boss, I'm thinking of investing in this product. Is it good? Now, the moment you try to confirm, what are the risks? Let me tell you. First of all, from whom you are confirming? Let me tell you very frankly. Generally, we confirm from whom? Maybe our friends, our relatives, our colleagues. But are they also a financial expert? Do they know all these things? So if I'm confirming this thing from somebody maybe who is not so well versed or who does not know much about that thing, what I should be expecting from him, whether he's going to give me a correct reply or wrong reply, that's first thing. The second thing is, now again today, everybody has got an ego. And if you try to negate somebody's view, counter it, maybe you say, no, boss, no, that's not a good decision. It's not a right decision. Don't do it. And many people get offended also at times. Now, since we know all these things, maybe that person is not going to take a risk of offending you. He will say, yes, yes, you're doing right. So once I confirm it, without knowing whether the person with whom I'm confirming is right source or not, and I'm getting, let's say, a confirmation from everybody, maybe it can lead to a wrong decision. So that's another bias, which is confirmation bias. So there are a lot of biases which are there. Another bias is a recency bias, let me tell you. Now, what is recency bias? Generally, we get impacted more by something which we have heard or read or seen in short or immediate term. So that impact is more in our mind. We don't we remember something which has happened in a distant future, maybe 1 year, 5 years. We don't remember, hardly remember. If you put your pressure on your mind, then you are going to remember. But something which has happened just recently, we remember it. Now, if something good has happened, you form a good opinion. If something bad has happened, that is also equally true. You form a bad opinion. But again, that's not correct, because that's a recency bias. Investment is not for short term, it's for long term. Greed and fear, now that's the biggest behavioral bias, and that's human psychology. I mean, we've become greedy at times. For example, let's say I have invested in some XYZ stock, 1 lakh rupees, just 3 months back. And just because market has gone up, prices of the security has gone up, it has become 3 lakh, let's say, in a very short span of time. Now again, we become greedy. And what we do? Maybe we are expose more money at a price which may be on the very higher side. And if tomorrow some correction happens, then I feel the pain. The other thing is fear. Now the fear of losing is so much in our mind, which is in the case of most of the people, they don't even try to explore or look for the favorable or good opportunities. Fear of losing. Now this fear of losing, one has to look at very rationally. So let's say if I'm having a fear, I'll put it very simple. I have to look at it, why I'm having this fear. Why? Why this fear? What is the reason? If I've heard from somebody's story, should I be imbibing the same? Or even if, let's say, I had my own bad experience, I should be fearful from that thing? No, I need to explore. Explore why I made loss. And when you explore it, you will see that maybe you took a wrong decision. Maybe you invested at a very wrong price at a wrong time. Maybe even if you invested in a good security, let's say it was meant for long term, but you, out of panic, you sold it in short term and you made a loss. So again, when you explore it, you need to look at the performance of that product. Whether that product has been always doing bad. Of course, if it has done bad, then yes, there is a reason to believe. But if not, the same product has given good result, many people have gained out of it, then why to fear? So again, it needs to explore all these things. Taxes. Now, it's a very, very important thing. We have already talked about it. All investment products, whenever you are gaining anything of it, whether you are getting interest income, dividend income, or when you are selling at a higher price than what you have purchased it, you are getting a capital gain. Now, capital gain again is also taxed based on again what type of security it is. So again, all those things are there. You are liable to pay tax as per the tax structure. And whatever you pay tax, your net return gets reduced by that much. Let's say if you are doing through some stockbroker or some professional, then you are paying some fees, some charges are there, demat charges are there, stockbroking charges are there. So many things are there. This is a very, very important factor. Investing without a purpose of goal. Now, as I was telling you very clearly, investment is nothing but a deferred consumption. And when I'm talking about consumption, it is made by money. So investment is nothing but a money management. Let's put it this way, very simple. So whenever I'm investing, I have got some purpose. I require 5 lakh, I require 10 lakh, I require whatever the amount is there. That means there has to be some goal. When I talk about goal, there are 3 things. Let me tell you. These are the 3 things. One is purpose. Objective. For my daughter's marriage, for children education, for retirement, for purchase of car, what it could be anything. Let's say holidaying, it could be anything. Purpose. I want. But the second thing is when, and the last one is how much. When I require money, how much money I need. So goal has got these three things, both purpose and of course when I need it, which is time, maybe after 1 month, after 3 years, after 15 years, how much I require it, 10 lakh, 20 lakh, 30 lakh. So whenever you are investing, it should be the purpose of goal. And if you do it goal-based investment, then of course you are going to gain only, not going to lose. So what are the strategies which has to be followed? Have a clear financial goal, which I already explained to you. The objective, the purpose should be very clear. How much you need and by when. Now, all assets are good. All investment products are good, but all are not good at all point of time. Or maybe not suitable for everybody. Let's put it this way. Now, if you look at historically the asset performance, whether it's gold, whether it's equity, whether large cap, mid cap, small cap, or real estate, or even debt, you will not find that all assets have done well on a year-to-year basis. Maybe some asset has done better than the others. Some assets have been which has given a very, very good return, good double-digit return, has given a negative return at some point of time. So within assets also, there will be performance variation at different point of time. So that's why what is required is I should not be putting all eggs in one basket. That means all my money in one asset. Because as I told you, all assets are good, but yes, not good at every point of time or for every. So diversification has to be there across asset classes. Let's say, for example, I want something anytime. Maybe I'll put my money in a liquid fund, or maybe it's lying in a saving bank account or something like that. Maybe I want something in a short term. So again, you have to look at some debt product, mid term, maybe mix of debt or equity, long term equity, gold. Again, gold does well when the economy and political situation is not good. So maybe again that situation can also come. So you need to diversification across all these things. Diversification within asset class also. Maybe not everything. If I've selected equity, then not everything in one form of equity. Something in large cap, mid cap, small cap. More should be always in a stable type of product. So large cap is more stable. So I will be exposing more of my money in large cap, but of course some exposure will be there on the other side also. Maybe I want to take advantage of market cycle. Maybe this industry is expected to do very well. So maybe I'm having some exposure on that particular industry. Clarity on return with respect to risk. That's very, very important, which I have been talking. Some investment products are volatile. Anything can happen. And particularly risk is more in short term. In long term, you get a normal return or good return. But it is the short term which is what impacts. So again, looking at your requirement, again, risk and return has to be there. Rupee cost averaging, now which is very, very important concept called SIP, which I'll be talking in the coming slide. Now there is another concept or a way to investment which is called systematic investment plan, which is called SIP. Now this is just a process, the way to invest. We have heard a proverb in Hindi which is called "Boond boond se ghara bharta hai." I think all of us have heard it. A lot of stories we have heard about it. So it is similar to that. With every drop, you are accumulating something. So SIP is that. Now, why SIP? Most of us maybe are employed somewhere and we are getting monthly salary on a fixed date. And we are spending that money for the rest of the month as per our requirement. And yes, we are supposed to save also and invest. So before we spend and we end up without any surplus, or saving, it's always better that I get salary on the first of the month in my bank account, and maybe by third or whatever date I have chosen, let my investment go. So this is again a very, very disciplined way of investment, where what happens, you have pre-decided which scheme to invest, when to invest, and how much to invest. So that's all a decision to be taken by the investor, which is fixed sum of money at a regular interval, whatever you have decided. So let's say you have decided 5,000 to invest on third of the month in XYZ fund. So every month, this 5,000 will be going into that fund on a regular basis. One-time mandate is already given to the bank. Auto debit is happening. So now today everything is electronic, so we know money is moving out. But why there is a need of SIP? We need to understand. Now, generally when we take decisions, investment decisions, at times we become emotional also. Now, what is emotion? Let me tell you. We are looking at certain news, views, prices movement, market movements, sometimes going up, sometimes going down, volatility is there. So maybe I can think, okay, let's me wait for another one day. Oh, the prices has gone down, the NAV has got down. Let me wait for another one day. NAV is a price of a unit in a mutual fund as per the market value. So we try to time the market. Now, nobody in the world, let me tell you, has been able to successfully time the market at all point of time. Maybe in few occasions some can be lucky, but not always. That's one thing. And as I was telling you, of course, emotion plays very well. Let's say, for example, let's say if I want to invest in a particular fund, the NAV is 30 rupees. Now, let's say I could not invest. I waited. Let me see what will be the price tomorrow. And from 30, it goes down to 28. Now, suddenly something will go in my mind. Why? Maybe the prices can go again less. And next day again, maybe it has gone down to 26. So here what I'm trying to do, I'm trying to time the market. I want to enter at a price which is low so that I get more number of units. So, and in that way, what happens? Maybe I'm not able to time the market. Because when you're looking all these things, you are getting confused. So the best way to get out of this thing where you are confused is to have a very, very disciplined approach. So to maintain discipline without looking at the market level, without looking the prices or net asset value, I have decided, irrespective of that, I'm going to invest in XYZ product. It helps in the accumulation of the corpus. Of course, it has to be long term, and SIP works very well, particularly in equity asset, growth asset. What are the advantages of SIP? No need to time the market, which we have already talked about it. Rupee cost averaging. Now, it's a very, very important thing. Let's say, for example, I invested today and the net asset value was 12 rupees, let's say. Next month, the same due date, which I've decided, I invest and the net asset value is, let's say, 20. So I am investing 5,000 here, let's say. I have invested 5,000 here next month. So 5,000 divided by 12, I'm going to get some units. 5,000 divided by 20, I'm going to get some units. Now, when I look at the total, for 2 months only, it is 32, whereas I've invested 10,000. Sorry. Now, if I look at the average price, it becomes 60. So this is what is called rupee cost averaging. Now, here I have taken only for 2 months. Please mind it. But if I am investing for 60 months or 120 months, that means 5 years, 10 years, 15 years, 20 years, then what happens? In long term, it has been seen that this average cost is less and decreasing. So this is one advantage of a SIP, rupee cost averaging. Now, the second one is benefit of compounding. Now, since I have invested 5,000, so what is happening? 10,000, 15,000, 20,000. The base is growing. The base is growing. That's one part. The second thing is, if I have invested in a growth asset in particular, let's say equity, we know after some time, let's say after 5 years or 7 years, you start getting a positive return. Now, as your base has grown, and if you continue to get a positive return on that base, then your return also magnifies like anything. So this is another advantage of benefit of power of compounding, which we have already talked. Now here again, I would like to go back to the rupee cost averaging. Now, it's very, very important today. Let's say I decided to invest on 3rd of the month. So 3rd I have invested, let's say it is 12 rupees. Now again, I'll be investing the next one 3rd. But somebody is also investing on the 4th. Let's say if he's investing on 4th, and if the average here is invested at 14, so here it becomes 26. So here the average again becomes 13. So when I look from my own investment, of course, on a monthly basis, I know this happens. But when I've invested in a mutual fund, where daily somebody is investing or redeeming, then this average is happening on a daily basis. That's another advantage. So this is another way of advantage, a disciplined way of saving and investing. I'm not looking at the market. I'm not looking at the price. I know based on my requirement, this is where I have to invest. And as I told you, SIP does well in a long term, particularly in a growth asset, because you get the advantage of rupee cost averaging, power of compounding, all these things you get it. So this is a very, very good way of investment. So this is again, if you look at it as it is being shown. Now what happens? Somebody might be thinking, what will happen? Let's say if I'm investing 5,000, there are two things, NAV and the other one is unit, which I'm getting. So 5,000 divided by NAV, you are going to get units. For example, let's say if the NAV was 20 rupees, then you are going to get 250 units. Same, next, let's say another time when you are investing, so if the NAV is 25, you are going to get 200 units. So what has happened? Somebody might think here the prices has gone up, but I have got lesser number of units. But here if you look at it, the overall becomes 450. So if I multiply this 450 by 25, your value has gone up. That's one way of looking at it. Now let's take another situation. Let's say NAV has again gone to, let's say less, 18. So in this case, you are going to get a more number of units. Now, somebody might think that my total investment value has gone less. So let's say in this case, if somebody thinks ki NAV has gone down, but here again you are going to get more number of units. You are going to get more than 250. It will be more than that, more than this. Now, we need to understand that this, whatever SIP you are doing for a long term. So, in long term, let me tell you, since there are only two things which is going to impact your total investment value, for a long term, NAV, as we have seen, keeps on growing. It keeps on growing. Let me put it this way. Whereas units also keeps on adding. So this will continue. That means NAV multiplied by units in long term is going to give a very, very good amount to me. As I told you, this works very well in long term. in short term, there can be ups and downs. So the person, as we have seen in the earlier slide, one has to be disciplined. And we have talked about earlier, if out of fear or panic or getting emotionally impacted, if you get out of the fund or you stop doing SIP, then of course. And I told you earlier also, it's not that the investment or the product has made you loss. No, your own behavior has made you loss. Ultimately, if you look at it. So, but if you have got patience, discipline, long term, of course, you are going to gain in long term. So this is the biggest advantage of a SIP. So let's look at it from this example. Let's say if somebody is investing 1,000 rupees and it is growing at a rate of 15%, though in short term it will not grow, but maybe at the end of some 10 years, 15 years, you can calculate it, it has grown by 15%. So it grows slowly if you look at it. If I have to draw a line, let me just look at it. If you remember, I said that it's like a takeoff of an aircraft. It might not grow very rapidly initially, but after some time you will find it's just growing very rapidly. So what has happened? Just see. 27,788, then it is growing to 45,116. Finally, it becomes to 6,8,507, which is 6,68,507. So SIP does very well in long term, particularly in a growth asset. But what is important is disciplined approach. That's one fact. Not get panicked by short-term volatility. In fact, it is an advantage to you, because if the NAV goes down, you acquire more number of units. So in long term, both NAV also goes up and you acquire more number of units. So unit multiplied by NAV, you get the more number of amount at your disposal. So this is the best way to create a good corpus or accumulate the wealth. So now finally we are going to end up. And what has been the key takeaways or learning? Understand the trade-off between risk and return. And as I told you, risk and return are the two sides of the same coin. So I need to understand both the things. Higher the risk, higher the return. Lower the risk, lower the return. It's very simple. So should I be taking higher risk? And what do you mean by higher risk? Higher risk does not mean losing capital. Please. Higher risk means being tolerant towards the notional risk, which is only on paper. So I have to be very clear on that. Clarity about your investment goal, because whatever you are doing for yourself, for your family, some goal, some objective is there. When I want my money, how much I want my money. So that has to be complete, and investment has to be done accordingly. Invest across asset classes, diversification. Why diversification? Because no assets does well at all point of time. And you want to go for a safe growth, managing your both liquidity, safety, and growth. So you have to find balance. That's why you need a diversification, asset allocation. Stay disciplined, save, and invest regularly. Regularly is a key here. So once I have decided that this is for me only, for benefit of me and my family only, whatever I am going to accumulate, invest is going to help me only. So it should not be made a one-time activity or ad hoc activity. It should not that whenever I'm going to have some surplus, I'm going to invest. Sorry. You always define your saving very clearly. This much I have to save and invest. And then you spend whatever it may be. You have to do a very, very fine balancing. We have already talked about regular expenses, variable and discretionary. So you have to do budgeting and all other things. You have to save. You have to save, and then you have to channelize that save to invest regularly every month. Financial education must for managing risk, which we have talked earlier. The more you get financially educated, when I'm saying financially educated, it's not about knowing about the return. It's knowing about the risk, the impact of risk, and also how to counter that risk. So once you know all these things, of course, it is going to help you to manage the risk and generate good return, which is what you want for investment. So now I want to thank all of you for giving your invaluable time for this session, and I hope I have made things very, very clear in simple words how you should be going about as far as investment decision is concerned. So, on behalf of NISM, I again thank you and wish you all the best for your future investment journey. Thanks.